morning. Welcome to IG's Early Morning Call. It's Wednesday, 8th of March. Let's take a look at the headlines as we await the start of today's European session, where we're expecting losses pretty much across the board as a result of what we heard late yesterday coming through from the US and the Federal Reserve with its news that it wants to continue to keep its foot on the pedal so far as interest rates are concerned. And as a result of that, we've seen markets twisted by the hawkish rhetoric from Jerome Powell yesterday. Canadian dollar, meanwhile, in focus today. We've got the Bank of Canada expected to keep interest rates unchanged. If it is, it could well be a seminal moment because it's the first of the major Western central banks to leave rates on hold in the current interest rate cycle. And the sportswear manufacturer Adidas posting a loss in the fourth quarter, and it slashed its dividend. All concerns about its relationship, its now off relationship with Kanye West. Take a look at the volatility. And as I said, the Powell comments have really twisted pretty much every single asset class. Well, every single asset class, pretty much every single market. The bottom line is that the people are no longer prepared to take on risk in the current rate environment that's been outlined by Jerome Powell. And we'll get an update on precisely what he said in just a minute. But the net effect of this was an increase in volatility back up over 20, currently trading at 20.49. Second day in a row of gains, as you can see. And if you look at the 30-minute chart, you can see, I think, pretty clearly here where we saw the news coming through. Initially, we saw a pullback, and then we saw volatility rise as we saw these markets pull back. And that has really illustrated the whole effect of what we've got in terms of the market moves in the session today. The London FTSE 100 today is down for a fourth day in a row on the 24-hour market. It's expecting a lower start to the trading day. It's not a big drop on from the losses that we saw yesterday. And to be fair, the losses yesterday weren't as perhaps maybe as severe here in London as many thought they might be. A slightly weaker sterling helping to support that market. The German DAX hit slightly more yesterday. But in fact, in yesterday's session, we saw a new higher high, taking us up to levels not seen in 13 months. And then came the pullback, and today another red candle. So illustrating what is a loss across the European markets today. Third day in a row of losses from the French markets on from the intraday record high we saw at the back end or the beginning of this week at 74.02. 73.07 is where we are now, so we lost a whole full 100 points in 3 days of trade. Overnight in Asia, in Hong Kong, Cathay Pacific posted an annual loss of $834 million, larger than last year's, but was positive about its outlook as its quarantine is no longer required. That was one of the stocks that perhaps maybe performed better than others. The Hang Seng Stock Index, so you can see, down 2.25% plus at the moment. ASX 200 losing 0.75%. That Japanese market is an interesting one. It's the only major global market to have seen gains, and this is as a result of the weaker Japanese yen. This is the Nikkei. We are approaching the highs that we saw established back on the 24th of November last year. We are at highs for the year, but this market, as I say, bucking the trend that we've got across other global markets because of that weaker Japanese yen. Wall Street closed as of yesterday. Just wanted to show you what's going on in a broad sweep of the markets. And it was the Dow that was the worst performer in yesterday's session, down 1.75%. Let's take a look at the chart of the Dow. You can see this loss that we saw there. And as I showed you that 30-minute candle chart for the volatility, same sort of performance as we saw money coming out of these equity markets in yesterday's session, but obviously equal and opposite, because that increase in volatility indicates risk-off attitude towards the markets, which you can see as at the point we saw Jerome Powell start to speak at 3 o'clock yesterday afternoon UK time. We got this slide in place. And in fact, we flatlined since the low point we had back last night at 7:30, an hour and a half before the close of Wall Street last night. So to be honest with you, we're not actually much moved from where we closed out yesterday's session at 32,848. So the Fed Chairman Jerome Powell warning that the US Federal Reserve is prepared to return to bigger interest rate rises to fight inflation. Basically, he was hawkish in pretty much everything he said yesterday. In his congressional appearance yesterday, the first public intervention since data showed that the central bank is struggling to bring inflation under control. Despite a year-long campaign of monetary tightening. Jerome Powell signaling in his speech yesterday his willingness to ratchet up interest rate increases to combat persistent price rises. Let's take a look at one of the quotes that came through yesterday. He told the Senate Banking Committee that the ultimate level of interest rates is likely to be higher than previously anticipated, and said recent economic data was stronger than expected. He also said if the totality of the data were to indicate that faster tightening is warranted, the Fed would be prepared to increase the pace of rate hikes. It prompted a stock market sell-off, as we've just seen, and also a rise in the US dollar, which I can show you now. If you look at the dollar basket here on this chart, here you can see quite clearly the rise that we've seen with money going into the dollar on expectations that the Fed is more than happy to continue to raise rates. And in fact, in today's session, the intraday trade that we've just seen, we're just bubbling below this line of support at 105.37, which were the highs we had back on the 6th of January. But in fact, we have pierced that line of resistance today with a high there at the moment at 105.51, which is the highest trade we've seen since the 1st of December last year. So we are, what's that, for 5-6 month highs for the dollar basket. No surprise there's what's happening with the dollar jumping on Jerome Powell's comments. Let me just show you what's happening in other markets around the world. You can see sterling has dropped below this line of support established with the low point we had back on the 6th of January, and we are now there, a low for the year. Lows not seen since the 21st of November for sterling against the US dollar. I was talking about the moves on the Nikkei 225 prompted by the weakness in the Japanese yen. The mechanics behind that are quite easy to understand when you know that Japan has a lot of exporters. And as a result of that weakness for the Japanese yen, you can see here, and in fact, in today's session, the dollar has risen above the 200-day moving average, as well as rising to levels not seen there now since the 20th of December, above the 200-day moving average at 137.55. This is the dollar rising against the weaker Japanese yen, causing that purchase of risk assets in Japan, those exporters benefiting from the weaker Japanese yen. Let's look as well at what's happening in some of the other markets, because many other markets around the world have moved as a result of this. Big losses for silver yesterday, crashing through its line of support, which, to be fair, had already been broken a week or two ago. That line of support was established back at the 2058 level back on the 21st of November. And here we are now trading at the lowest levels you've seen for silver since the 4th of November last year, at just over $20 the ounce. The US dollar also creating havoc in the gold markets, but not falling quite as much. Well, certainly not technically breaking this line of support here, not breaking that line of support at 1805. But it was a big slide nonetheless yesterday, taking us down there to levels not seen since Tuesday, 28th of February. So that's where things are in terms of the overall move in what's been happening with precious metals. And it's the same message I think we're getting right the way across all these metals markets. Yesterday, the price of copper down on the session in yesterday's trade, and you can see we're holding on to those losses that we saw yesterday in the session so far on this Wednesday morning. One other thing worth watching in terms of the foreign exchange markets is the Bank of Canada meeting today to look at interest rates, and the expectations are the BOC is likely to become the first major central bank to hit pause on its interest rate policy, with eyes on what policymakers will say about the next steps. Let's take a look at what we are expecting. Tiff Macklem, he's the chief of the BOC, and his governing council are expected to hold the benchmark overnight rate at 4.5%, ending that streak of 8 consecutive rises that we have seen. That would follow through on a January pledge to keep rates where they are for a while, as the bank assesses the impact of its tight monetary policy. Economic growth has been slowing in Canada at the first three quarters of 2022 and stalled in Q4. As for inflation, it reached its peak in June 2022 at 8.1%. In January, it decelerated to 5.9% year on year, undershooting expectations of 6.1%. But to be fair, it is still at levels which are well above the move that or well above expectations and well above the move that the central bank wants to see on its inflation target. Let's take a look at what's happening in dollar CAD. This is the US dollar rising against the Canadian dollar ahead of that interest rate decision today. And we are at the highest level there, not seen since the 3rd of November. So that data out, I think, at 3 o'clock this afternoon could be an interesting trade to watch out for. Do watch out for this when we get that news coming through from the Bank of Canada and how it thinks about the outlook for interest rates. If there's anything like the sort of rhetoric that we've seen from a very hawkish Jerome Powell yesterday. If the Bank of Canada is expected to go back to raising interest rates, I think we could well see some of this move up for the US dollar against Canadian unwound. Interesting to see what happens there. Let's take a look at German data out in the last half hour. Industrial production numbers. We've seen retail sales and got some data for you here. 3.5% in January production was up month on month after a slide of 2.4% in December. Expectations had been for a gain, but not by anything like as much as we've seen. We were looking for 1.4%. Retail sales down 6.9% though in January year on year. Consensus have been for a loss of 6.1%. Before I show you euro dollar, at 10 o'clock this morning, we get the final estimates of Eurozone fourth quarter GDP. Market expects a 0.4% rise quarter on quarter, 1.5% year on year. As the European Central Bank continues to raise interest rates, we have seen growth start to be hit. Be interested to see if there's any downside risk to these growth numbers, and just to see what has been happening as we've seen the European Central Bank continue to tighten monetary policy. 1:15 p.m. today, we get the private payroll data out in the States. US private sector is forecast to have created 200,000 jobs in February. Meanwhile, on Friday, that's after 206,000 in January, I should say. On Friday, February non-farm payrolls, we're looking there as well for 200,000 job creations after that absolute stunning number out in January of 517,000. The unemployment rate forecast to remain at 3.4%. Remember, of course, we were looking for unemployment rate to remain at 3.6%, I think it was last month, and it dropped by 0.2 percentage points. Average hourly earnings expected to rise 4.7% year on year after a 4.4% rise in January. So all that data due to come out today. And I'll be watching what's happening with the euro-dollar trade. In today's session, we are above this line of support at 104.83, which were the lows we had back on the 6th of January. If you are short on this, if you think the data out today could well highlight the frailties in the European economy and this continued buoyancy in the US, if you're short on this at 105.47, your stop would go in this area up here, just above the recent top of recent candles, around about the 107 level. 105.45 is where we are. The 104.83 is the line of support we could see broken. We're being held up by the blue line here, which is the 100-period moving average. Possibly a little bit of significance with that. But this line of support at 104.83, if you get a break of that, you're then down to levels not seen since the 1st of December last year, which mirrors what we're seeing for that move up in the US dollar basket. Let's take a look now at some of the stocks to watch. I want to begin, first of all, with one of the stocks that's really been a great performer under its chief executive, who is now leaving. That's Legal & General. It's posting a pre-tax profit of £2.66 billion. Operating profit up 12% to 2.52 billion. Now, that is stronger than had been forecast by analysts who've been looking at these results this morning. The group says it's on track to achieve its 5-year plan. The full year dividend up 5% to 19.37 pence. I want to show you the chart for Legal & General. In the last couple of days, it has pierced and indeed closed beyond what had been this line of resistance, 265.4 pence. It will open at 266. This move up we've seen is ahead of this number this morning, and despite the fact we got a good number, like is always the case, do you see the market sell off on the news? There is no reason to sell this stock particularly necessarily all the way down. It has been one of the better performers. It's got a great asset management team, and as of the intraday trade yesterday, it was at its highest since the 13th of September last year. This move is moving up with this market at 266 pence at the open, and we'll have to see what happens when we move into the start of today's session at the top of the hour. Let's take a look as well at another chart I want to take a look at, which is the cybersecurity company, Darktrace, 266.4 pence. The company will open in the wake of news out this morning that would appear to be good, but still some question marks about its long-term accounting, because it has seen a really big drop in its net profit. Revenue's up 38.5%. 99.3% of revenue is coming through from recurring subscription-based contracts that continue to average approximately 36 months. Margins up 50 basis points to 89.7. Adjusted EBITDA up 32%. Now, this looks good in the grand scheme of things, but it's lowered its guidance for full-year cash flow due to an accounting change related to its listing, as it reported a 36% rise in first half revenue. The company said Its guidance for 2023 range of free cash flow will be about 50 to 55% of adjusted core earnings. Now, that's down from a previous estimate of 60 to 65%, and that could be the element here that could well see a drop in shares. Now, we've got an opening at 266. We've got support at 253, which was the low established a couple of weeks ago, Friday, 24th of February. Excuse me. You can see this line of support has been of interest over the last few months or so. That first established back on the 29th of December. And as I said, despite the fact it's come up with some really good headline numbers with revenues and adjusted EBITDA up strongly, I think the outlook is a little bit concerning. It is an accounting adjustment that needs to be established and needs to be made, but it will be a drag on resources for the company as it looks out for its 2023 guidance, lower than expected. Watch out for dark trace at the start of today's session. I want to switch on to another chart where I think we could well see some gains. This rising line of support for Galliford Try could well be a good friend for those that want to continue the upside for Galliford Try. Profit before tax up a whopping 65% to £11.7 million before exceptionals. Revenue up 14% to £679 million. Operating margins increasing 2.3%, and the dividend up 36% to 3 pence per share. This all looks very good. It's also given a little bit of additional capital to return to shareholders, up to £15 million through the group's ongoing share buyback programme. Full year pre-tax profit expected to be at the upper end of the current analysis, and it's confident about the outlook. So how do you trade this? I think as a trader, you'd want to be long going into the start of today's session. We are seeing 4 days in a row of losses going into these numbers this morning. I've got this rising line of support. As a technical analyst, it's worth considering how to trade this sort of trend. And you'd want to put your stop under the underside of this rising line of support if you're long on this. It's not a trade recommendation as such. It's just a positioning in my mind, bearing in mind where we closed out yesterday's session, where we've got the technicals and this line of rising support. Your stop would go underneath that at around about the 167 pence level, opening at 174.5. And I think if this market does what I think it possibly could well do, we could well end up getting it past this line of resistance at 178.3, which would then take us to levels intraday not seen since July last year. We'll have to see how things open at the start today. We've got a little bit of pressure building on the overall markets at the start of today's trade because of concerns about the outlook for interest rates, which also apply here in the UK. I think Galliford Try certainly well positioned, possibly for one of the outstanding gainers on the session in today's trade. Another stock worth watching, I think it's going to be Tullow Oil. This is the company which is focused on the markets in Africa. It has had a torrid time of it. The group's 2022 free cash flow is up from $245 to $267 million. It's posted a net income of $49 million. All this is pretty much in forecast, but it's been supported by increased equity in its Ghana operations and higher oil prices. It plans now to invest £400 million in capital expenditure, mainly on its flagship fields in Ghana. Now, this itself could actually be a little bit of a negative for the stock. We're opening at 34.1, and we got support just below where we are at this line down here at 32 pence. So that's where we are with Tullow Oil. Weakness continuing to build for the company as it continues to invest in fields in Ghana. One of the stocks we were going to be watching today was that of Adidas, and I don't think it's really disappointed. We've been worried about the downside, and this continues to build for Adidas, a sportswear manufacturer, posting an operating loss of 724 million euros and a net loss for continuing operations of 482 million. What's behind this? It's the termination of the Kanye West partnership. It's had a negative impact. A whopping 600 million euros was the hit the company has taken because of that. The sports apparel group is seeing an additional negative impact in 2023 of 500 million. This is a company that's invested heavily in the Kanye West brand, if you like. And then, of course, everything started to turn sour when he started to announce some very strange commentary around his views on the world. And the company has abandoned their relationship, and they've been left with enormous amounts of stock as a result of that. The chief executive, Bjorn Gulden, adding the group needs to reduce inventories and lower discounts and then start to build a profitable business again in 2024. Let me show you what's happening with the share price chart for Adidas, which have been one of these companies, as I said, we've been looking ahead. The stock is down 3.1% in the pre-market at the moment, which would take us below the 200-day moving average. We're opening at 144.88, and it's down over 3% in the early part of today's session. Adidas sees underlying operating profit at break-even in 2023, reflecting a sales loss of 1.2 billion euros from that point of not selling the stock that it had built up. So it's had to take a hit of more than 600 euros. As a result of that, Adidas plans to slash its 2022 dividend to 0.7 euros per share. Its dividend a year earlier stood at 3.3 euros, 3.30 euros. So it's a massive drop in dividends. Adidas, rising line of support, is going to be broken at the start today because we've got early indications that the stock is down 3% when the trade gets open at the top of the hour. Let's change on to Weight Watchers. A positive story, up yesterday by a whopping 80.36%. After the company said it planned to buy Sequence, a telehealth platform that provides treatment for obesity. Stock closing up the market value of $490 million. Just want to show you one other area of the market which we haven't discussed today, and that's oil. Yesterday hit, I guess part of this drop we saw yesterday was as a result of Jerome Powell's comments. The more you see interest rates go up, the more likely it is economies will shrink, and therefore the more likely it is the outcome that will have less demand for oil. So that's part of what we had yesterday. That's opening on the way down as well today at 82.79. API data yesterday, little impact on prices. According to the Institute, the American Petroleum Institute, crude oil inventories in the US fell 3.8 million barrels last week. Gasoline inventories rising by 1.8 million and distillates up by a similar 1.9 million barrels. As for crude oil production, it stayed at 12.3 million barrels of oil per day last week, the highest production rate since last April 2020. That's it. Got quite a lot of companies to watch at the start today. Could be quite an interesting open at the beginning of today's session for me. Adidas is by far and away the most interesting stock to watch out for. Here in the UK, do watch out for Legal & General. Some nice numbers out there today. Galliford tried ditto, but are concerned about the potential outlook for dark trades. We'll have to see how things unfold at the top of the hour. We're currently something like around about 7 or 8 minutes away from the beginning of today's session. We'll be back later on, 10:30 with Charman Jerome Powell.